Back. Oh, nice. Thank you, John. We're live. Paul, it's Wednesday. Big Fed Day. Holy smokes. July meeting. Month end is tomorrow. Also have GDP numbers today. Also have non-farm on Friday. Are you ready?
Sure. Let's do it.
Can you tell that I've drank half a cup of coffee already, and I usually don't do that?
I can tell. You came in really hot today. It was unexpected. But yeah, we're excited.
I got to sleep I was in bed pre-7 p.m. print. Girlfriend thought that was weird.
It's early. It
was pretty early. Tired. Needed to get ready for today, for this 3-day stretch.
Yeah.
It's going to be, hopefully, a wild adventure. I was talking to Glenn yesterday, and we were looking at the calendar of events. And actually, if the boys out there wouldn't mind bringing up, and ladies, sorry, they're ladies as well, bringing up the calendar just so we have it in the backdrop to show what the heck's going on. ADP employment change, not normally, not your father's most important economic calendar item, but right now, very important given how important employment has been in the U.S. the last handful of months. GDP number right afterwards here this morning. This will be in 45 minutes, and then in an hour. So that's 8:30 Eastern, 7:30 Central. We're in Chicago. It's showing the Chicago. Bank of Canada right afterwards. That should also be pretty interesting, as we'll get into the Canadian dollar in just a second, but Canadian dollar starting to get hit a little bit after a pretty strong run out of CAD. FOMC, obviously, this afternoon. That's going to be 1 o'clock Central, 2 Eastern, and you can adjust for wherever the heck you are existing here in the world. Bank of Japan tonight, Paul. Yeah. Holy smokes. We haven't even gotten out of Wednesday. And then you look at the fact that tomorrow, I don't think we have too much U.S. data. We got personal income. Oh, my gosh, we do have the inflation. I forgot about inflation tomorrow. And, of course, the initial jobless claims. That'll be the same time as inflation. That's 7:30 Central, 8:30 Eastern tomorrow morning. And then finally, non-farm payrolls on Friday. That's like 6-7 major events. And I, ever the hipster, said to Glenn yesterday that it seems like if anything is going to be the least relevant, it might be the Fed meeting this afternoon. What do you think?
Potentially.
Okay.
But also potentially not. We don't know what Jay Powell's going to say.
Of course not.
Yeah, we have no idea.
But what's your hot take?
The hot take is that he somehow sprinkles out a resignation. That would be the hot take.
Well, that would quickly become the biggest of the major events we have.
Yeah.
If he sprinkled in a little bit of, and also I'm resigning.
Yeah, that would be interesting. You would probably see it right away on the initial news because they usually announce his kind of written speech right away. So if it's in that, you would know pretty quickly. I have no idea what it would do to markets. It would be a very interesting thing to kind of digest.
I think it would be very bearish dollar. I think it would send equities and everything else into a lot of back and forth, a lot of indecisiveness. Yeah, I have no clue, but yeah, I would imagine a Powell resignation that's probably trading right now at like 20-1 odds, or maybe more. What do you think would be the market on a Powell resignation today?
We'd probably look it up, but 20-1 seems low. I mean, I'm baking some juice. Yeah, 21 probably was right. Yeah.
Like trading, yeah, like on a prediction market for like, do you think it would be for more or less than essentially 5 pennies? I think that would be the equivalent of 20-1, right? Mm-hmm. Probably right around there.
Yeah, right around there.
Anyways, I don't know if that will happen, but I do know that these data points have just been very, very interesting the last month or two. We've just gotten so much back and forth on them. Even last month, we had the employment data leading up to non-farm was negative, and then the employment data that came from non-farm. And of course, if you don't know the first Friday of the month, the U.S. reports its employment data, and that is let me pull up that data point. That is tomorrow, Thursday, July 31st, and then of course this is August 1st, the first Friday of August, and so you'll get the U.S. Unemployment rate, and you'll get the change in jobs. That's the non-farm payrolls number. But leading up to that number, Paul, we get like 3 or 4 kind of like lower tier. I don't. It's like the opening acts for the non-farm payrolls, and they've been zigging and zagging. Usually, it's supposed to be like, oh, like if the ADP employment data and the JOLTS data, if all this data is like positive, then the non-farm will probably be positive. But last month we saw like negative, and then a really positive non-farm number. And so you saw some really whippy moves on a week like this. With the employment data expected to be a little bit higher of an unemployment rate and a little bit lower, but still positive change in unemployment, we were staring at exactly this last month, Paul. And when we were staring at this, there was a greater chance of a potential rate cut for today's meeting. Now there's pretty much no chance of a rate cut for today's meeting. And we're looking at the same setup where there's a good chance of a rate cut in September, the next meeting. This is all to say, if this employment data comes in weak, then maybe there's a case for a rate cut, ease a little bit of the economic tension in the U.S., but of course, as you and I are very aware of, the first 6, now 7 months of the year haven't got any rate cuts because there's not as much tension in the U.S. economy as we've thought. Yeah. What say you around all this data and, the opportunity for a rate cut in September? Because that's really what this week is about. It's not about what the heck is going to be the rate decision today. It's likely going to be no change at all. It's like 97% chance. I'll bring it up while you talk. But we're all looking at September, right?
Yeah, we're all looking at September. But I'll point to the job number yesterday, which was JOLTS, which is job openings, in kind of layman terms. JOLTS have been steadily declining, so job openings have been steadily declining for the better part of the last year. You can actually go and click into this, and you'll see these job openings were almost at 1 million job openings a year ago, and now it has started to shrink. So that typically is not necessarily a great sign for the job market, but it just means there's less jobs open out there. Could also mean that people have filled, but we haven't really seen the unemployment number actually tick down enough where that it would suggest that. So that's kind of an interesting kind of the underneath the surface of the jobs numbers. It's really hard to say. The job market really hasn't made a whole lot of sense. We've kind of been expecting it to turn over at some point, and it hasn't really turned over. I think we've been talking about the jobs market waiting for a turnover for the last couple of years. So it will be interesting to see how this data comes out. Interesting to see what Jay Powell says about kind of the job market, but inflation's still sticky too. So it's interesting.
You highlight the key kind of crux of this cut, don't cut debate, which is everyone has been kind of looking at the U.S. economy and expecting it, and it has retracted in certain ways. I mean, we're going to get GDP number today. The last print was negative. And so you've seen definitely a contraction from how hot we came out of the pandemic gates in 2021 and 2022 and even into 23 and parts of 24, because we've been talking about this impending slowdown now for years, literally. Because we did get some cuts last year because we've started to see some of these signs. And you highlight, the JOLTS part of it, showing a little bit of this, like, okay, well, they're not as many job openings. And you even talk to whoever, friends, family, whoever, it does feel like there's less opportunity in the job market. But then you do look at the fact that non-farm hasn't really slipped below 100K, and they keep expecting to get some really bad prints like this week. And yeah, if we get a sub 110K print this week, I think that'll be a pretty big red flag for all of those doves out there, all of the interest rate bears or the bond bulls, so to speak. That like, yeah, okay, we finally need to get our first cut of 2025 because we're now really starting to. It's not just the JOLTS number; it's JOLTS and it's GDP and it's non-farm and it's all these things. But yeah, the the elephant in the room, or like the weird cousin or whatever you want to say, is this inflation data, which I believe is tomorrow. I totally forgot about it.
Yeah.
Where are we? PCE. Which just hasn't dropped. And you look at it from, I mean, you can look at it a couple of different ways. I'll look at the year over year. This is a number that the Fed has wanted to get down to 2%. And you might say, well, Frank and Paul, you know, like we got 2.3%, they're expecting 2.5%. Is it really got to be 2%? And the answer is no, but there is some fear from the Fed that it's just like it's sticky above 2%. It's not like, oh, we got a 1.8 print and then we got a 2.1. It's like we got down close to 2, and then we've seen some 2.5, and they're expecting another 2.5% print. And so it's just hard to make this case for lower rates from the Fed right now, even though the president really wants them. Because you have these certain economic factors that aren't necessarily pointing to like severe economic contraction in the U.S. And then you have the, like I say, the weird cousin in the room, which is this inflation that hasn't gotten down to 2%.
Yeah. And historically, we think of rate cuts as typically ahead of a recession, some sort of real actual economic slowdown. And data doesn't necessarily say that yet. We've had a little bit less uncertainty now. We've had some trade deals come through. Not smart enough to know if they're good trade deals or bad trade deals.
No clue.
No idea, but the dollar's been loving it. We have seen some dollar strength over the last week.
Look at that, Paul, with the segue, because that's all your stuff. Today, of course, you've got GDP, you've got some employment data that's actually going to come out very soon, and then you have GDP, and then you have the Fed. You also, if you all the Forex heads out there, if you care about it, you've got Bank of Canada sometime in between there and Bank of Japan. And we'll cover the other stuff the rest of the week. But yeah, let's segue into some of the markets because I also want to get your eyes on a study real quick. A little bit of calm before the storm, but holy smokes, you're just continuing to see this dollar upside. I want to start with Aussie, but just to highlight here, you've got Euro continuing lower, getting scarily close. I mean, we're a 1 hour candle away from 115 if this continues. Dollar, Swiss franc continuing to see some upside, not huge. Love to see dollar CAD getting close to 138. That has been a tough trade for a number of people. But I want to start with this Aussie, because, man, they are pounding it going into today's U.S. session, Paul. What the heck is going on, you know?
It's a tough one. I mean, it's been pretty much dollar rallying across the board. Did have a tsunami come through last night. I don't know if that's going to have any impact. It's definitely going to have some sort of impact come through. There was an earthquake just off the far east side of Russia, which was the biggest earthquake since 2011.
Holy smokes!
Yeah, this all happened.
This is
overnight.
the craziest week of all time.
Yeah, I haven't seen any of the damage reports yet, but I have seen there were some pretty big waves. Obviously,
I hope everybody's okay.
Yeah, so that does obviously the human aspect is very important to highlight, but there's also big economic impacts of that, and what that causes. Is it a short-term supply shock? I won't use the word transitory because I think that doesn't make any sense, but I'll digress. But yeah, it's been an interesting one. We haven't really had an RBA rate decision this week. It's kind of just been dollar buying. Not
a lot of fundamentals that I can find. And even yesterday, I was like, oh, man, like after we get off the show, I'll check on Chinese equities or anything surrounding it. And it's like, Not really much there. Maybe there's an opportunity. Anybody out there who likes to, go across asset class for pairs trading, maybe there's something to look at that divergence. But just, yeah, pretty wild move in here. Obviously, Euro getting a lot of the headlines, but for this Aussie market to get up above 66, looks like it might finally take, I mean, we've seen this so many times the last couple of months, looks like it might finally take the lead in some of this this currency bull action we've seen since April. And now it's of course turned hard, and it's actually one of the weakest, now well below 65 cents. And we'll see how close it gets to these recent lows of 64 cents the last couple of months of action. Really quick, just a couple other things to highlight. Like I said, the euro continuing to see some downside. We are right back here at those lows that we saw yesterday morning. Everybody staring at 115, which will be really interesting if we get down there. Obviously, that is the low going back to this mess here, end of June. And the last time we were below 115 was really on the way up in euros. So definitely you look at this price action, Paul, and every step of the way that it looks like they might try to bounce this thing. 116.50 here, no bounce. 116 even, there's some junk in here. Oh, maybe we'll pick up here. No, sir. Right down to 115.50, trying to bounce a couple of times yesterday, and we are right back down there. So feeling quite weak for this euro currency. Anything, say you, before we get into some slides?
Yeah. You do have to remember, and I think we talked about it a couple weeks ago, there was probably the net short kind of institutional players were net short the dollar at one of the highest levels going into this kind of past week. It does look like they were on the wrong side of it, and we're basically given the good old tap on the shoulder to get out of that trade, which is where you see some of this kind of extended moves, and it doesn't look like it bounced. So that's kind of the underlying market dynamics. It has moved 250 points in 2 days, which is quite significant. So we'll see. It's definitely, it's almost, you could argue it's at extremes, but relatively it's not.
Last thing, I did forget to mention this yesterday, but I do want to mention it just for anybody out there. Take a look at the non-dollar popular pairs in here, just because we brought this up last week. And I think even a notification went out to the tastyfx peeps that this euro sterling trade got up to highs. This is the hourly chart. Let me take a look at the daily. Yeah, we got up to new highs for the last year plus. And man, they took this market down with a vengeance this week. This is Sunday night, and then it has been a bloodbath in this euro sterling pair. So obviously, we've seen, Paul just said, euro's down 250 points against the dollar. So there's plenty of action in there. But man, take a look at some of these non-dollar crosses, because they've been seeing some wonky extremes and some pretty big reversals as well. But let's get into the slides. It's going to be a lightning round of a fun study to show Paul. If my friends out in Les Productions can get us to the other screen, I can bring up the slides. Anybody out there?
So we do it live, right?
There we go. There's my friends. All right. Let's manage some profit expectations, Paul. We have been on a tear of Forex research, looking at what times you should maybe play a contrarian play a trend play. Of course, we're looking at historical data, and that is not indicative of the future. But it is a wealth of information that can, like I was talking to Glenn yesterday, it's never like, oh, we did all this research, and so now, like, here's the exact numbers that you need to look for entering a trade, for exiting a trade. And it's like, oh, this, in our research, like, it showed that this market has had the most mean reversion historically. So, like, that's the market that everyone should pile into. Of course not. That's not why we do these things. We do these things because you out there have your own trade ideas. And these are kind of guidelines of, like, yeah, if you have a good trade going, maybe try to take 40 points out of it. And if you're sitting there being like, I want 100 points, it's like, we're going to let you know how realistic that is. It's some guidelines, right?
Yeah.
So let's get into it. Why are we looking at long dollar positions, Paul? Because the dollar has been pretty beat up. We've seen decade-long lows in the dollar against Swiss franc. We've seen multi-month, in some cases multi-year lows in the dollar against a handful of markets, euro. Not so much those commodity currencies, but a lot of that euro, Swiss franc, pound. It's been pretty rough. And so a lot of people may be thinking, especially the last 48, 72 hours, whatever you want to say, hey, this dollar's seen a little bit of a comeback here. Maybe it's a blip on the way to more dollar lows. What should I be doing? Where should I be managing my trades here? It might be more important than your entry at the end of the day.
Yeah. Yeah. And it's always comes down to your targets is how I've always liked to say it. You'll hear people talk about actually using a hard stop loss, and there's people that use mental stop losses. People use that mental kind of take profit or limits. It's all kind of up to you, but I'm interested to see what Glenn has done for us. I kind of keep in mind, I pay attention to price action, and if I start to see the price action flip, that's my strategy. But again, it's all dependent on your person, all dependent on your risk tolerance too.
Sure. Yeah. And yeah, today's study, looking at 2022 to present, a handful of popular USD pairs. In there, you got your euro, pound, yen, Aussie, CAD, Swiss franc, and Kiwi. Simulated the trade performance of long US dollar positions. So that'd be short euro dollar, short pound, long dollar yen, short Aussie, long dollar CAD, and so on. And entered at the daily close price. So no kind of crazy stuff on where we're entering. You can look at past studies for stuff on like, should we enter after this many down days or this big of a down day in the dollar or whatever. And looked at a 10-day maximum time period and essentially just looked at, okay, well, what are the success rates in taking symmetric take profit and stop loss? And of course, you could do this in the platform is set, like I want, 10 points or 20 points or 30 points of take profit. You can also do the same thing on the loss side. A lot of people will do it symmetrically because then, of course, you're looking for just a win rate that's north of 50% to theoretically engineer a net profitable trade. If every time I'm taking 10 points of profit or loss and I'm winning 55% of the time, theoretically, you would have a profitable strategy. Again, not indicative of future results, and a lot of this stuff is theory meant to guide you on your journey. Here we are, Paul. Here's all the pairs in your rows, and on the columns, you have the profit and loss targets at 20 points, 30 points, 40 points, 50 points, all the way to 100, which, of course, 100 for like a euro dollar market or a pound dollar market or an Australian dollar USD market is equivalent to a penny. Is that right? Yeah. Yeah, I got that right. Mm-hmm. In terms of the exchange rate. That doesn't really matter, but just a fun little thing to toss at you to maybe clicks with you. Are you surprised by how much green is on the board? Are you surprised by how much white is on the board and where it's all distributed?
I'm not surprised by dollar yen at all. Because we started, we did the study from 2022, so you just look at that daily chart and you'll be like, okay, yes, that makes sense why long dollar positions have generally worked for dollar yen. Obviously, the yen's weakened against the dollar over the last 3-4 years. It is interesting how high some of the win percentages are as far as the 20-point range. That is interesting because for me, you're putting a very tight kind of collar on your trade, mm-hmm. Where if it goes 20 points against you, you're out. 20 points in your favor, you're out. It is surprising how high those win rates are. That would be kind of my area.
Cool. And yeah, my thing with these results is, again, this isn't meant to say like, oh man, I just got to get long dollar yen and just take 20 or 30 points out of it every time. And it's like, it's always going to win. Absolutely not what we're saying. But yeah, it is interesting to see that in this area of taking, 20, 30, 40 points, you're seeing a lot of over 50% percentages. For me, the real takeaway is outside of 50 points, you're not seeing a lot of 50 plus win rates. Now, of course, if you're taking big winners and small losers, then a 40% success rate can maybe work for you. But if you're trying to do a high probability strategy where you're winning, 55, 60, 65, of course, I hope everybody wins all the time. Not the way it usually goes. Then you're looking for more 20, 30, 40, 50 points. And of course, the days in the trade say essentially the same thing, Paul. Here, we're looking at how many days it would take to get to these profits. And again, I don't think it's any coincidence that you're seeing a lot of one-handle prints in the 20 to 50 range. And then when you get outside of 50, you're getting pretty quickly to 3s and 4s and even 5s, telling me that, like, if I'm looking for high probability plays, I'm looking to manage my exposure. I don't want to have big volatility in my P&L, then I'm looking for 20, 30, 40, 50 point profit loss metrics. And I'm looking for, if my trade is on for outside of 2.5 days, it looks like it starts to get pretty volatile.
Yeah. It does speak to that. If these markets are against you more than 50 points, it could at that point be a little late to get out, but you maybe should have managed that position. Maybe you should be thinking about managing that position right around the 50 level at the worst, right? But it all depends really on your setup. This is a good study by Glenn. It gives you we've talked about mechanics a bunch, but this kind of gives you the idea of where to start thinking on how to set your profit target, how to set your stop loss, and kind of what levels to be thinking about.
100%. And with that, here are your takeaways. Dollars exhibited persistent positive drift across all major pairs over the last 3 years. So again, you can't take this as being like, oh, the dollar's just always going to win. There are different markets all the time, and we like to be kind of agnostic to the side. When the dollar starts getting, punished, we'll take the other side of the trades, of course, whatever works for you. 20, 30 pip targets have been the most consistent with 60% win rates. Dollar yen demonstrates exceptional trend persistence, maintaining above 50% win rates even to the 100 pip targets. Of course, we're in a little bit of a crazy dollar yen trade the last few years. But really, again, the takeaway for me is 20, 30, 40, 50 pips seems like a decent place where my strategy can still be successful. And also, the time in the trade tells you that, like, once you're getting outside of 2 days, your win rates seem to drop off. And when this trade is going to be able to be managed for a loss or a profit, quickly becomes 4 or 5 days. So a couple of interesting foundational pieces for you. With that, we will toss it over to Tom, Tony, and Vanetta coming up next.
Global markets never sleep. Explore them with Forex, now available on tastytrade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on tastytrade.
One of the things that was most intriguing about the financial space to us is just that there wasn't